Good afternoon, Assumptionista. Welcome to the Accounting Information News Express, where the news comes first. We're live on Accounting 109. Today on Accounting Information System News Express, we will hear and see all the hottest and most current events circling around the world of revenue and cash collection processes and controls. Many people who want to try businesses and still don't know how the revenue processes and computers works. Knowledge on the sales processes is very essential. An expert says, there are cases that the goods being sold will return to the seller. How do company manage the risk and control of these situations and what are their procedures? Company-to-company sales are typically made on account, and a time span is given to customers to pay, and along with discussed collections from sales revenue is the specific internal control and related risk. Overviewing the IT system of revenue and cash collections, how does it enhance the revenue processes efficiency? Learning of e-business system and the related risk and control. What are they? EDI system can cause risks that may differ from those found in traditional manual or IT system. Why so? Point of sale system can enhance customer satisfactions by enabling faster and more accurate checkouts. But how it can reduce some processing integrity risk within revenue and cash collection processes? Many businesses and accounting environment are that many deceptions and fraudulent acts related to revenue measurements and recognitions. Corporate governance implies ethical behavior. What should be done to guarantee that the company assets are properly designed and implemented? Many people who want to try businesses and still don't know how the revenue processes and computers works. Renelyn will tell us more.
Yes, Irvin. In the real world, many companies, either large or small, have systems and processes in place to capture, record, summarize, and report the results of their daily transactions, especially the revenue process. Like in Staples Company, who sells not just to their customers but also to other large corporations. To improve performance in filling customer orders and collecting cash, Staples monitors the following performance measures. First, order entry accuracy. Second, order fill rate versus unit fill rate. Third, percent of items mispicked. Fourth, percent of orders delivered the next day. And lastly, the products delivered undamaged. And to perform in these areas, Staples must have processes in place to enter customer orders, pick the correct items from the warehouse shelves, package and ship the items properly, bill the customer correctly, and collect the payment promptly. In this diagram, you can see the transactions, processes, and the resulting reports. In the transactions, there is a large volume of daily sales, returns, and cash inflow transactions, and then it proceeds to the revenue and return processes, systems and controls, then to the general ledger processes, systems and controls. Then the resulting reports, such as the balance sheet, income statement, and cash flow statement is produced. And in the internal reports, such as sales, inventory status, cash flow, and aged receivables, etc. Additional knowledge. Sales transactions also generate other related transactions. Some of these are the movement of inventory to customers, the recording of accounts receivable, the collection of cash receipts, and the processing of sales returns. So, I have received some online questions from the internet. So, to read a question from an anonymous one, he says, I'm curious. What specific software do companies use in generating activities, and how are these transactions being handled or generated? So, to answer, in an integrated and automated accounting system or the ERP system, the related transactions are automatically recorded as part of the sales transaction. For example, Microsoft Dynamics GP. It is a fully integrated system that allows one transaction to be entered and all related transactions to be updated at the same time or when the appropriate activity occur. These various transactions are generated automatically by the Microsoft Dynamics GP, Automated Accounting ERP System. These may differ from company to company, but there tend to be similarities in the way they carry out related business processes. For an instance, in this exhibit, you can see a transaction or activity, its explanation, and how the transactions are generated. So, I picked the subsequent cash collection. The explanation with this is that if the original invoice is for items sold on account, the following occurs when the customer's payment is received. The invoice that was recorded in the accounts receivable subsidiary module will be selected and the open accounts receivable is recorded as paid. Only the cash receipts has to be entered. The information for the invoice that is being collected can be selected without the re-recording of the information. And the transactions generated is a cash receipt that is being recorded in the accounts receivable module. The invoice being collected is selected from the open invoices for the customer. And the accounts receivable subsidiary ledger is updated for the receipt. Then, the cash receipt is automatically recorded in the bank reconciliation module. Then lastly, the generated ledger is automatically updated to reflect the increase in cash and reduction in accounts receivable. And that is how these revenue processes and transactions are being generated using an ERP system. So the second online question that we have here, this anonymous person asked, are these safe and can we really trust on these software and programs? If so, what risks are there? So, to answer, of course, businesses have to consider the risks that may occur in a business, especially the revenue and cash collection. Recorded transactions may not be valid or complete. That is, they may involve a fictitious customer or an incorrect quantities or terms or any erroneous duplication. Recorded transactions may not be valid or complete. Recorded transactions may be recorded in the wrong customer account, may not be recorded in a timely manner, and may not be accumulated or transferred to the accounting records correctly. So, these are the things that many companies have to consider and understand in order to perform efficiently in many areas using an automated system, especially in recording the revenue that a company acquires. Back to you, Erwin.
Knowledge on the sales processes is very essential. An expert says,
Yes, Erwin. The sales process is simple. It simply begins when a customer or buyer places an order with a company who sells something. But when it relates with the accounting information system, it becomes very complex. Let me show you why. In this process map, you can see the 7 different departments or offices that are involved in a single sale transaction, wherein source document plays a very big significance in a business. 2 of the most commonly used documents are the purchase order and the sales order. I know that we are all quite familiar with these documents. So, can anyone in the live audience differentiate the two? Miss Karen Fehimeri, can you differentiate the sales order and the purchase order? Miss Karen? Thank you, Miss Karen. So, you can see that after the sales department received the purchase order, they verify the prices and immediately prepare sales order. Then, the credit department sees if the customer is within credit limit. If yes, notification message is sent right away. Inventory control sees if it is available, and if yes, they go straight to the stock warehouse. and the shipping department checks the sales order and pack the item based on the exact amount indicated. They then prepare shipping documents and update the accounts receivable records as well as the general ledger. So this illustration shows a much detailed source document flowchart of a sales process. As you can see, a series of different documents is identified, handled, and kept by each department. They make sure that their customers get the necessary documents for them and compile these in a single file accessible by every department in the company. Moving back to sales order, as the primary source document, the source of these prices is the price list. So can I ask anyone from the live audiences again? What is a price list? Mr. Jaymar Cruda, can you define what is a price list? Mr. Jaymar Cruda? So thank you, Mr. Jaymar. That is correct. So next, this exhibit here shows a price list for a product in a Microsoft Dynamics GP. Notice that the same item includes different prices for sales at retail and for sales that is returned. The price at retail is at full 100%. The next 80% that you can see indicates that they put a 20% discount in this particular item number 2-A3284A. So that is how a list price of a product in Microsoft Dynamics GP is generated. Next, once a sales order is in the system, the customer's credit status must be checked. For existing customers, a new sale on account should be approved only if it is determined that the customer has not exceeded the established credit limit. So, I have mentioned earlier the credit limit. So, what is a credit limit? Can I ask Ms. Charmin Tribajo, what is a credit limit? Ms. Charmin? That is right. Given a limit, each customer should have a pre-established credit limit, which designates the maximum amount of credit the company is willing to extend to that customer. That credit limit may be adjusted on a basis of payment history and the current amount of uncollected sales outstanding. So if a sales order is for a new customer, the creditworthiness of that customer must be evaluated before the sale is approved. As a new customer are entered into the system, a credit limit must be set for them. Am I clear? Can I see your heart reactions if you get me? So, thank you. You can see on the screen a credit limit of $25,000 for a customer, Alton Manufacturing, as it would be established in Microsoft Dynamics GP accounting software. Whether it is a new or an existing customer, customer records must be examined to determine whether to accept the sale. Additional knowledge. It is also important to check the inventory to determine whether the items ordered are in stock. In the Microsoft Dynamics GP, when the order is entered, the system automatically checks to see if there is available inventory in stock. So what if in any chance there is a quantity shortage? What will a company do? A company may sell the balance. In this way, the quantity available in inventory for the site will be allocated or assigned to the order or invoice. The company can also override shortage. In this way, the shortage will be ignored and the entire quantity will be sold on the order or invoice. The quantity available in inventory will then be negative. This option exists because a company may have physically received inventory or plans to receive the inventory items shortly, but then they have not yet been received or entered in the Microsoft Dynamics GP. Next that the company can do is do a back order all. In this method, the entire quantity will appear in the quantity to back order field and the quantity sold will be 0. This option is selected when customers prefer to not receive partial shipments but instead prefer to receive all items at one time. Next is the back order balance. In this option is similar to the back order all functionality except that the quantity shortage will appear in the quantity to back order field and the quantity the seller has available in the inventory will be sold. So, the cancel all. This option, the entire quantity for the item will be canceled. Nothing will be back ordered and nothing would be sold for this line item. Then, the cancel balance. In this option, the quantity shortage amount will be canceled and the quantity the company has available will be sold. And lastly, the distribute option. The distribute option allows you to select substitute inventory items and sell items from another warehouse or inventory site if items are available in other locations. So that is distribute. So those are all the options that a company can do if in any chance there will be a shortage in stock. Additionally, these are the following source documents that are very important in the sales processes. And I do believe that these documents are very familiar and are already common to our live audiences. First off is the picking ticket. A picking ticket is prepared if the items ordered are in stock to document the quantities and descriptions of items ordered. Items on the picking ticket should be pulled from the warehouse shelves and packaged for the customer. A packing slip. It is prepared by the warehouse personnel and it lists all items included in a shipment. Bill of lading. Bill of lading is where the terms of the agreement between the company and the carrier are documented. And a shipping log is a chronological listing of shipments that allows management to track the status of sales and to answer customer inquiries regarding order status. Next is the sales invoice, or typically referred to as a bill. A sales invoice provides details of the sale and request payment. Lastly, a sales journal. Sales journal, as a sort of review, is a special journal that records sales transactions. Additional knowledge. In a Microsoft Dynamics GP, once a sales transaction is recorded or entered, the sales journal, the general ledger, and the customer statement can be automatically generated without having to enter any additional transactional data. If you can recall, there are 5 internal control procedures that are described in the Chapter 3, and the following are the procedures that are associated with the sales processes. Firstly, in the authorization of transactions, specific individuals within the company should have authoritative responsibility for establishing sale prices, payment terms, credit limits, and guidelines for accepting new customers. Only designated employees should perform these authorization functions, and this minimizes the related risks of those invalid and wrong fictitious customer, overextended customers, and unapproved pricing or incorrect amounts of customers. Next is the segregation of duties, where the accounting duties related to order entry, credit approval, shipping, billing, information systems, and general accounting need to be separated in order to meet the objectives of internal controls. It is to minimize the related risk of occurrence of fictitious customers, invalid sales, or omitted transactions, etc. The third control is the records and documents. In terms of records and documents adequacy, There should be a preparation of shipping log and packing list only when products have actually been shipped in order to transactions that are invalid are avoided and to avoid also omitted transactions or timing issues. As records are prepared, they should be compared with supporting information to make sure that they are accurate to prevent duplication. Fourth control is security. Security of assets and documents having physical controls in inventory and shipping areas such as surveillance cameras, security guards and alarm system to avoid invalid sales or omitted transactions. And lastly, having independent checks or reconciliation control. Companies should implement procedures whereby independent checks and record reconciliations are performed on a regular basis in order to minimize the risk of problems with the accumulation and transfer to the general ledger and financial statements. To conclude, the sales process or the revenue process is indeed very complicated and crucial. So, to be able to understand and be knowledgeable enough of how the system works is very essential for the businesses to thrive in the market in the long run. This is Ranalyn Pitabino reporting. Back to you, Erwin.
There are cases of the goods being sold will return to the seller. How do company manage the risk and control of these situations and what are their procedures? This and other stories of today's news run up by Celeste Hingpit. Celeste?
It is nearly always the case that a small portion of sales made to customers will ultimately be returned to the seller. That's why company must have procedures in place for receiving returned goods, crediting customer accounts, and placing the items back in inventory. When customers return goods, the goods are handled by the receiving department. These returned goods are typically accompanied by documentation from the customer, such as a bill of lading and packing slip. The goods should be inspected for possible damage, and reference to the original sales invoice should confirm the historical sale of the goods. In situation where there are returned goods, the company must prepare receiving log that lists the chronological sequence of all returned items and a receiving report which records the quantity received. A receiving report is a source document completed by personnel in the company's receiving area that documents the quantity and condition of items received. If the returned goods are accepted, they are placed back in the proper location in the warehouse, and the inventory records are updated to reflect the increase in inventory. We have also the credit memorandum that is prepared to document the return and to adjust the amount of the customer's credit status. A journal of credit memos should be maintained in order to provide a complete listing of all credits issued. Reference to the original sales invoice and approved price list will assure that the credit is issued for the correct amount. Sometimes, a refund check may be issued to the customer, and in other cases, the customer's account receivable balance will be adjusted for the returned items. Along with these sales return processes is the risk being attached to it. That's why the following specific controls should be implemented. First, authorization of transactions. Certain designated individuals within the company should be assigned the authority to develop sales return policies, authorize sales returns, and approve credit memos. Others within the organization should recognize these specific individuals and should not process returns if they have not been approved by the designated person. Second, segregation of duties. For sales returns, an effective system of internal controls segregates individuals with authoritative duties from those responsible for recording and custody. Ideally, anyone who performs a credit memo activity should not also be responsible for data entry, credit approval, shipping and handling inventory, billing, information systems, or general accounting. Third, adequate records and documents. Internal controls over sales return records are similar to those for the sales process, whereby the reports documenting movement of the goods and the related notification to the customer should be issued sequentially, organized, and retained. In addition, it is important to match receiving reports for returns with the respective credit memos in order to ensure that the company issues credit for all returns and for the proper amounts. Returns are also matched with the original sale invoices in order to verify quantities, prices, and item descriptions. Credits for returned products should also be included in customers' account statements. Fourth, security of assets and documents. Data files, production programs, and accounts receivable records should be restricted to those who are specifically authorized to approve or record the related transactions. Custody of the related assets should be controlled and limited to those specifically designated to handle the receipts or move the returned products. Security over returns has requirements similar to security for the sales process. Lastly, independent checks and reconciliation. These functions should be performed by someone other than the employee responsible for the regular authorization, recording, and custody of transactions and assets within this process. These controls are similar to the ones performed in the sales process, except that the credit memo and receiving report are the new documents resulting from sales return transactions. Some circumstances which may exist within a company's sales returns processes that indicate a high level of risk are: quantities of products returned are often difficult to determine. There is a high volume of credit memo activity. Product prices change frequently, or the pricing structure is otherwise complex. Returns are received at various locations, or the issuance of credit memos may occur at different locations. Returns are received by consignees or under other arrangements not directly controlled by the company. In addition to sales returns, companies may sometimes issue sales allowances as an accommodation to customers who receive defective merchandise, late shipments, or otherwise undesirable products. A sales allowance is a credit to the customer account made to compensate the customer for agreeing to keep such merchandise. And to be corrected, it was explained by one of the prominent accountants in our nation about the difference of sales allowances to sales return, since mostly thinks they are the same. So, how can we really differentiate sales allowances to sales return? Are they somehow the same or not? That's why a company should always consider the risk of each system to determine whether the cost of implementing a control procedure are worthwhile in terms of the benefits realized from that control. The higher the risk, the more controls are generally required, and the more costly its accounting system may become. This is Celeste Mihingpit reporting.
Company-to-company sales are typically made on account, and a time span is given to customers to pay, and along with discussed collections from sales revenue is the specific intercontrol and related risks. Joining us in discussion, Ms. Celeste Mihingpit. Celeste?
There are cases that several of the sales are made on account, and customers are given a time span for them to pay. An example of the credit terms of sale would be net 30. This means the customer has 30 days after the invoice date to pay. Therefore, the timing of a cash collection is such that there will be some number of days between invoice date and collection of the cash. When the customer sends a check, the company must have processes in place to properly handle the receipt. The appropriate employees should match the check with the related sales invoice, deposit the funds in a timely manner, and update customer and cash records. Collections from customers typically include a remittance advice, which is the documentation accompanying payment that identifies the customer account number and invoice to which the payment applies. An example of a remittance advice can be seen on a paper-based credit card statement. This remittance that is returned enables the company to apply payment to the correct account. In the case of company-to-company sales, a remittance advice identifies the invoice and customer account number to which the payment should be applied. For each check received, the customer's payment must be matched with the appropriate invoice or invoices. A list of all cash collections is prepared, and the checks received are recorded in the cash receipts journal. A cash receipts journal is a special journal that records all cash collections. The listing of collections is to be forwarded along with the payments received to a cashier who prepares the bank deposit. The payments are deposited in the company account, and customer records and cash records must be updated. At the end of the month, an updated statement of account will be prepared and sent to the customer. This statement reflects the invoices that have been paid and the decrease in the customer's balance owed as a result of these collections. Also, the bank will provide the company with a monthly statement so that the company's cash records can be reconciled to the bank records. In cash collection from sales revenue, we also have specific internal controls and related risks associated with it. Some internal controls present within a cash receipts process are as follows. First, authorization of transactions. Appropriate individuals should be assigned responsibility for opening and closing all bank accounts and approving bank deposits or electronic transfers of funds. This ensures that records are updated only for authorized transactions. Second, segregation of duties. As you know, authorization duties need to be kept separate from recording and custody duties. Recording responsibilities include maintaining a cash receipts journal, updating accounts receivable records for individual customers, and posting accounts receivable subsidiary ledgers totals to the general ledger. Custody responsibilities include opening mail, preparing a list of collections, handling receipts of currency and checks, and preparing bank deposits. At a minimum, those who handle cash should not have the authority to access the company's accounting records or reconcile the bank account. Third, adequate records and documents. Cash receipts listing should be prepared on a daily basis, so the daily activity of collections should be reconciled to supporting documentation from the bank deposit. Bank deposit receipts should be retained and filed chronologically, and regular, timely bank reconciliations should be prepared and retained. Detailed customer accounts should also be maintained and reconciled with customer statements regularly. Fourth, security of assets and documents. Access to cash collections need to be limited to those who are expressly authorized to handle cash. Controls over cash collections are likely the most important control procedure because cash is the asset most susceptible to theft or misappropriation. Cash collections should be deposited in the bank in a timely manner to prevent the risk of theft. Also, Related computerized data files and programs must be protected from unauthorized use. Lastly, independent checks and reconciliation. A physical count of cash needs to be conducted from time to time in order to compare actual cash in hand with the amounts in the accounting records. To maximize effectiveness, cash counts should occur on a surprise basis and be conducted by someone not otherwise responsible for any cash receipts functions. The bank statements should be received directly by the person who prepares the reconciliation to make sure it is not altered by other company personnel. In addition to the need for tight controls over cash due to its susceptibility to theft, the following circumstances may indicate risk related to cash collections: high volume of cash collections, decentralized cash collections, lack of consistency in the volume or source of collections, presence of cash collections denominated in foreign currencies. And in order to properly monitor customer payments and determine the amount of an allowance for uncollectible accounts, an accounts receivable aging report should be generated to analyze all customer balances and the respective lengths of time that have elapsed since payments were due. And since most companies have occasional problems with customers who fail to pay, leading to the write-off of accounts receivable and the recording of an allowance for uncollectible accounts, live today in our AIS News Express, the CEO of the ABC company sharing some techniques in reducing risk related to transactions involving uncollectible accounts. This is Celeste Hingpit reporting.
Overviewing the IT system of revenue and cash collections, how does it enhance the revenue process's efficiency? For further information, Mary Escuñado is on. Mary Grace.
Thank you so much, Irvin. IT enables systems of revenue and cash collection processes. The previous section described the processes related to revenue transactions. In addition to the activities that take place within those processes, there must also be an accounting system to record, summarize, and report the results of the related transactions. In the majority of organizations, the accounting information system consists of hardware and software within IT systems. However, there is a great variety in accounting software systems in terms of their size, complexity, and extent of automation that is impossible to describe all of the various kinds of systems. In general, as complexity and automation increase, there are fewer manual processes and more computerized processes. This is also usually true regarding size. Larger IT systems generally have fewer manual processes and more computerized processes. More computerized processes means there would be a greater need for the type of IT controls, and it generally means that there are fewer paper documents within the process. The following sections provide a description of a typical revenue processing system and some specialized IT system. The system flowchart documents a system for company-to-company sales. When the customer's order is received, an employee enters it into an IT system by keying the order into an input screen. With online data files, the input data can be edited. The customer's credit status can be reviewed, and inventory levels can be checked. If the order does not exceed the customer's credit limit and the inventory items are available, the order can be processed. Order processing updates the sales records and customers' accounts records. The appropriate documents needed to fill and ship the order may be prepared. These documents usually include a pick list, a packing slip, an invoice, and a bill of lading. The pick list is used by warehouse personnel to select items from the warehouse shelves. The packing slip is used by shipping personnel to ensure the correct items are packed. The bill of lading is the agreement between the common carrier
such as tracking or trail transporter and the company. The invoice is sent to the customer. Usually, at the end of the month, customers are billed and regular monthly reports are generated. Customers are billed according to the customer statement. Regular monthly reports will include sales reports, inventory status reports, and accounts receivable reports. The general application controls used to ensure the security, availability, processing integrity, and confidentiality of the IT systems. General controls include authentications of users, computer logs, physical access controls, and business continuing planning. General controls to prevent network break-ins would be necessary if the system uses any network connections to the other systems. The application controls help ensure the accuracy and completeness of processing. Input controls used in the system would likely include data preparation and error handling procedures, program input validation checks, and control totals. Well-defined procedures for data preparation and error handling can reduce the chance for mistake in data entry in the system. The program input checks, such as failed checks, validity checks, limit checks, and reasonable checks, will help prevent or detect keying errors. If customers' orders are entered in batches, control totals can help ensure the accuracy and completeness of input and processing. Output control help to protect data through proper distribution, storage, and disposal of reports. The systems uses manual processes such as keying of data and some paper forms. More complex IT systems can reduce or eliminate these manual processes and paper forms. For example, orders placed over the internet would eliminate manual keying by someone within the company. The customers keys in the order while placing an order on the website. The sections that follows describe some types of systems with fewer manual processes and paper forms. In many companies today, sophisticated, highly integrated IT systems capture, record, and process revenue and cash collections events. These IT systems are more specialized than the generic described earlier. Such systems include e-commerce systems, electronic data interchange or EDI systems, and point of sales or POS systems. E-commerce systems incorporate electronic processing of sales-related activities, and generally e-commerce sales processes are transacted over the internet. Electronic data interchange or EDI systems communicate sales documents electronically with standard business format. Point of sale or POS systems process sales at cash registers in retail stores. When implementing these types of IT systems, many companies find that they must change the methods used to perform sales and collections. As companies redesign these processes to align with their software system, they conduct what is known as business process reengineering. Business process reengineering or BPR is the purposeful and organized changing of business processes to make the processes more efficient. BPR not only aligns business processes with the IT systems used to record processes, it also improves efficiency and effectiveness of these processes. Thus, the use of sophisticated IT systems usually leads to two kinds of efficiency improvements. First, the underlying processes are re-engineered to be conducted more efficiently. Second, the IT systems improve the efficiency of the related information. As an example, Nortel Networks Corporation, formerly known as Northern Telecom, found that EDI or electronic data interchange reduced its cost of purchasing from approximately $80 per transaction when paper-based to $35 per transaction with EDI. Explanation of three types of IT systems are included in the sections that follow, including e-commerce, EDI, and POS systems. Each of the systems greatly reduces or eliminates the paper-based documentation used in older manual and automated systems. That is, These systems may eliminate the need for paper-based sales orders or paper-based checks. In these IT systems, information is transmitted electronically and payments are collected electronically, not in paper documents. The elimination of paper completely changes the audit trail and the internal controls. Therefore, the sections that will follow will describe the risk and control for this IT system. This is Mary Grace Cunado reporting. Back to you, Irvin.
Learning of e-business system and the related risk and control. What are they? Learn well to Miss Mary Grace Cunado. Mary Grace.
Thank you, Irvin. Now, e-business systems and their related risk and control. Today, there are two popular types of internet sales, commonly referred to as business to consumer or B2C and business to business or B2B. Most people are familiar with B2C sales, whereby a retail or service firm sells directly to consumers using a website. This is also called an e-commerce. B2B sales, on the other hand, involve companies using websites to sell products and services to each other. These types of sales transactions are known as e-business. A more detailed transcription of e-commerce and e-business is presented here in Chapter 4. There are numerous B2C examples, including Amazon.com, CDUUniverse.com, and Lands End, J.Crew, and Delta Airlines. In a B2C sale, the company's website and the underlying network and software systems capture sales data, authorize credit card payments, and acknowledge the order via email. The details such as customer, shipping address, items ordered, and credit card number are captured on the website and uploaded into the company's accounting and logistics software systems. The website must interface with the company's data and inventory, customers' accounts, prices, and shipping charges. B2B is not as well known by those in general public. Like B2C, it involves the use of websites and the internet to conduct business. The difference is that the transactions are between companies rather than between a company and consumer. This difference is significant because a B2B sale is between known and trusted parties. The buyer and seller have pre-established business relationship and may have even negotiated prices and delivery expectation. In a B2C sale, the seller may not have any established relationship with the customer. In both B2B and B2C sales, the advantages of e-commerce include the following. First, reduced cost through lower marketing, employee, and paper cost. Second, shorter sales cycles due to reduced time to place an order, deliver the order, and collect payment. Third, increased accuracy and reliability of sales data. Fourth and last one, increased potential market for products and services. However, the internet-connected nature of e-commerce sales includes several risks that the company must manage. The network and internet connection required to conduct e-commerce are risk exposure areas or entry points. The risk involves security, availability, processing integrity, and confidentiality, among others. The risks related to internet sales are as follows. First, security and confidentiality, which include unauthorized access, hackers or others' network break-ins, repudiation of sales transaction. Second, processing integrity, which includes invalid data entered by customers, incomplete audit trail, errors when integrating data into back-end systems such as accounting, payment processing, and order fulfillment software systems. Third one is the availability, which includes hardware and software system failures that block customers from access to the website, virus and worm attacks, and denial of service attacks by hackers. In addition, there are many online privacy risks to customers. Customers' data must be safeguarded by internal controls. Controls should be in place to reduce the security, availability, processing integrity, and confidentiality risk. The controls that can lessen the risk are described in the next several. Security and confidentiality risk. To protect the security of the IT systems and the confidentiality of the data, it is important to ensure that those accessing the website and conducting sales transactions are valid and authorized users. User authentication is an important control for internet sales when it is possible to use it. In the case of retail sales to end users consumers, user authentication may not be appropriate. B2C companies that engage in retail sales do not always ask the user to create user IDs and passwords before buying on the website. Customers can perceive this requirement as burdensome or invasion of privacy. The need to sell to a wide range of unknown customers may prevent online retailers from using authentication controls. The cost of user authentication in terms of lost sales would outweigh any benefits of the controls. In other cases, such as B2B internet sales, authentication through user IDs and passwords is more important. To lessen the chance of fraudulent sales, sales without payment, and repudiation of sales, a company must institute controls to assure the authenticity of its customers and the sale. A real danger on internet sales that is the customer will use false or fictitious payment information in placing an order. A second danger is that the customer will repudiate a sale. Repudiate means that a customer claims to not have conducted the transactions. In both situations, it is important that a company have controls in place to ensure that the transactions is with the valid customers with valid payment authorization and that an audit trail is maintained. Customer authentication through user ID and password should also be used. Credit card authorization procedures must be correctly processed. Digital signatures or digital certificates can be used much like a paper signatures is used to authenticate and validate the customer. Finally, transactions should be logged and data trails maintained to avoid repudiation. Processing integrity risk. As customers enter data on a website to place an order, they make data entry errors. Controls should be used to minimize these errors. The programming within the website should include steps to check the completeness, accuracy, the validity of the data. You have probably noticed the effect of these controls when ordering items on a website. As two examples, consider what happens if you enter an incorrect state abbreviation or do not complete all necessary fields. Usually, the website provides feedback to you that a state abbreviation is not valid or all necessary fields had not been completed. These are program data input checks that should be built into any web-based sales system. The program checks should include such as field checks, validity checks, limit checks, range check, reasonable check, and sign check. In a web-based sales system, there probably is no trail of paper documents to serve as an audit trail. Therefore, the company must capture all relevant data and maintain the data in a form that constitutes an audit trail. Logging transaction can help establish an audit trail in an electronic environment. Dynamically programmed website that captures sales data can be considered the front end of the sales process. A company must develop a method to integrate the data captured into the back-end processes and applications. As an example of a back-end process is that one actually pulls items from warehouse and ships to customers. The data from the website must either be manually entered or integrated into these back-end processes. Controls must exist to ensure the accuracy of data as it is integrated across back-end processes. Such controls include reconciliation and verification. Data can be totaled as they come from the website and retotaled after they integrated into the back-end system. These two totals can be reconciled to make sure they agree. And the last one is the availability risk. Any interruptions to the system can cause critical problems for companies that sell via e-commerce. Anytime the website is unavailable to customers probably means lost sales. Therefore, the company should put controls in place to minimize service disruption. These controls can include redundant system, disasters recovery plans, testing of software changes, and capacity planning and testing. Redundancy is needed for servers, data, and networks. A redundant server systems requires maintaining one or more computers as extra. Backup web servers can operate if main server goes down. Data redundancy is usually accomplished by having data stores in RAID or redundant array of an expansive disk. A RAID storage maintains one or more disk drives that mirror each other. In this manner, one or more exact duplicates of the data are maintained. A backup network's construction should be in place if communication is lost through the regular network. Disaster recovery plans must be in place to ensure uninterrupted customers' access even through natural disasters such as fire, flood, or earthquake. The company must have plans to continue service when disasters occur. As changes are made to the website or the underlying software to process sales, it is important that the changes be tested before they are implemented. If such changes are not tested, they may fail and disrupt operation. Finally, manager must plan for sufficient capacity in the e-commerce systems and service to ensure that the system is not overwhelmed by the number of users accessing it. A slow or stalled website can result in lost sales. Managers should consistently monitor, test, and adjust the capacity of the system to meet its needs. This is Mary Grace Quiniano reporting. Back to you, Irvin.
EDI system can cause risks that may differ from those found in traditional manual or IT system. Why it's so? Mary Joy Nobleza will report this matter. Mary Joy?
Yes, Irvin, indeed. EDI system cause risks that may be different from those found in traditional manual or IT system. EDI eliminates much of what would be the traditional paper audit trail of documents, such as sales order, shipping documents, and invoices. It eliminates the traditional one. For an EDI system, the buyer and seller computer systems are connected and order data is exchanged electronically. EDI typically uses a value-added network or VAN, for it provides strong internal control or valuable services. Meaning, sa kabila ng kanyang pagkatibay na IT enablement, meron pa rin itong kaakibat na panganib sa organisasyon, kaya't kailangan pa rin natin tingnan ang mga controls, lalong-lalo na ang internal control nito. We already know what is EDI, or Electronic Data Interchange. It is to help expedite transaction wherein the exchange is completely automated, meaning no human intervention or management that happens. As what the picture illustrates, order data is exchanged electronically using EDI systems, which connects the trading partner and your business. Example nito is sa SM Appliance. Diba meron silang online website? You can check them online and inquire for items remained or stock available na gusto nimo palito na product. And if nakita mo na ang gusto mong bilhin, let's say refrigerator, and then you place your order into delivering and then you can pay it already automated using ATM or pwedeng credit card. So that's an example of re-engineered EDI. The order will happen online, computerized, and also the payment happen online. So magaganap na lang dito is less human intervention siya. And the physical contact of the item is yung delivery na lang. The EDI has three parts of this definition that highlights its important characteristics. The first one is intercompany, that refers two or more companies conducting business electronically. Other component is computer-to-computer aspects of the definition, indicates that each company computer are connected via network. So what if the two companies will not be directly connected? So the two companies could use a value-added network or VAN as a third party to serve as the provider. Na through that, they can still be connected sa ilang transaction. And the last component is a standard business format. It's necessary so that the companies can interact and trade with a variety of vendors and sellers using EDI. Specific to standard business format, it allows all vendors and sellers to speak the same language, meaning they can use preferable language that they typically used. Like sa Philippines, the standard is English, pwede sa Filipino language or other kinds of language. The American National Standards Institute, or ANSI, has developed standards formats for the usual documents needed in a sales process, including purchase orders, sales, invoice, price quotations, and shipping schedules. The standards in the United States is ANSI X.12. ANSI X.12 standards divide EDI data transmission into three parts: header and trailer data, labeling interchanges, and data segments. So, I will discuss each of these three standards parts of an EDI data transmission. So, the first one is header data. Header data is a data about the file or transmission being sent. The header identifies the beginning and end of a particular transaction data set. Trailer data is also data about the file or transmission and identifies the end of a particular transaction data set. Labeling interchanges identifies the type of transaction in the set, such as a set of sales invoices, while the data segments include the actual data within the invoice, such as quantities and prices. I have an example here. I searched in Google about the standard ANSI X.12. There is a segment name, element separator, data element, composite element separator, and segment separator. The NM is the segment name. The data segment is the number 808 or that comprises data. The element separator is the asterisk. The composite element separator is the colon, and the last segment separator has a symbol of tilde. If sa math, it means approximately, while in logic, it means not. And I have other picture here, the typical workflow example from the automotive industry. There is a supplier and a customer using EDI system and ERP system, or the enterprise resource planning. The workflow starts its delivery instruction to daily cutoff, to shipping notifications, to receiving advice, to invoice, to credit note, and to payment advised. In the illustration 8-19, EDI using third-party network. Although two companies may have a network connection that allows them to be directly linked to each other, it is expensive to develop and maintain such a system. The majority of companies using EDI communicate with trading partners by a third-party network, like the one illustrated in Exhibit 8-19. The two companies in Exhibit 8-19 are not directly connected to each other, but they communicate EDI data through a third-party network via mailboxes in the third party's computer system. These third-party networks are termed value-added networks or VANs because they provide other valuable services such as translation and encryption of the data, of the EDI data, and authentication of a valid and authorized trading partner. There are many advantages to an EDI system within the revenue and cash collection processes. Number 1, reduction or elimination of data keying. Number 2, elimination of keying errors. Number 3, elimination of costs related to keying and keying errors. Number 4, elimination of the time needed to K in orders. The first four advantages listed relate to time and cost saving from reducing or eliminating data keying. Since EDI transmit data between computers without paper documents, no data entry clerks are needed to key details of a sale from paper documents into the computer system. This saves time and pesos, as well as the errors that are inherent in keying data. The other advantages, number 5, elimination of mold delays. Number 6, elimination of postage cost. Advantages number 5 and 6 arise because data is sent electronically rather than by mail. Mail delays and the cost of mailing are completely avoided. As what I remembered in our ICT subject back then, usually emails are delivered instantly within seconds to the recipients. Advantage number 7, reduction in inventory levels as a result of shorter order cycle. Advantage number 7 occurs because there is a significant amount of time saved by avoiding keying errors and mail delays. This time saving can cut days from the time cycle to enter an order, ship it, and receive payment. Thus, the seller can maintain lower inventory levels and replenish those inventory levels more quickly. The remaining advantages, number 8, competitive advantage through better customer service. Number 9, preservation of business with existing customers who have adopted EDI. The last two advantages relate to getting or keeping competitive advantages. Sometimes a company needs EDI in order to survive. For example, to satisfy the transaction processing vendors or seller it already deals with. In other cases, EDI offers a competitive advantage by allowing a seller to more quickly and accurately service customers. Newer EDI systems use the internet rather than third-party networks to transmit EDI documents. Companies using internet EDI realize large cost saving because they avoid fees paid to a third-party network. Preferred nila ang EDI internet kasi nakikita nila na lalaki ang gagastuhin nila if they use third-party network. Kailangan pa nilang magbayad sa third party. So, EDI typically uses a value-added network or VAN, while internet EDI uses the internet to exchange data. Kaya those corporate large companies realize that they can use internet EDI than to expect cost. We are now in the real world. Nortel Networks is a global leader in telephony, data, wireless, and wireline solutions for the internet. Today, Nortel Networks is creating a high-performance internet that is more reliable and faster than ever before. It is redefining the economics and quality of networking and the internet through unified networks that promise a new era of collaboration, communication, and commerce. Sa paggamit nila ng EDI for decades, specifically sa internet EDI, it provides additional benefits to Nortel as it eliminates the need of phone purchase orders and reduce human error associated with keying data. EDI system cause risks that may be different from those found in the traditional manual or IT system. So these are the risks in EDI system are as follows. Security and confidentiality comprises number 1, unauthorized access. Number 2, trading partners gaining access to unauthorized data. Number 3, hackers or other network breaks in. Number 4, repudiation of sales transaction. Processing integrity. Number 5, invalid data entered by trading partners. Number 6, incomplete audit trail. Number 7, errors when integrating data into back-end systems, such as accounting payment processing, and order fulfilling software system. The next one, availability. Number 8, system failures such as hardware and software failures that block customers from accessing to the EDI system. As what I have mentioned in the previous slide, there are risks in EDI that classified into security and confidentiality, processing integrity, and availability. With a given risk in the organization, there are IT controls that can lessen this risk na makababa ng possible risk sa organisasyon. Ito ay authentication. Authentication is the process of user identification to ensure that only authorized users are accessing the IT system. Authentication occurs through the use of user ID, password, and other unique identifiers. Only valid, authorized trading partners should be allowed to initiate or receive EDI communication. For example, ang company, dili yun na sila gusto, diba, na their employees would make some fraudulent action. Like an employee who log in from a home computer and submit false orders to be delivered to her home address. Para malimit na ang ganyang activities or komunikasyon, they are to make an authorization to their trading partners or employees using software-based authentication techniques such as user account ID and password. The next IT controls is encryption. Since data travels over network, data lines, and third-party network, it is susceptible to network breaks in. So, encryption, the coding of the data that makes data unreadable, those without the encryption key, is a control that limits risk. Encryption of the data will not prevent these breaches but will render the data useless. So, encryption is talagang napaka-importante, di lamang sa individual kundi sa mga entities rin. Kaya kaya nitong protektahan ang sensitibong impormasyon. Example nito is websites that transit credit card and bank account numbers should always encrypt this information to prevent identify theft and fraud. Transaction logging occurs when the IT systems automatically produces a log of users and the actions they undertake within the IT system. So if nagagamit ka raw ng EDI or you conduct EDI transaction, it is automatically na nag-reflect sa inyong transaction log. And this log should be regularly examined and reconciled to ensure that no transactions are lost or unaccounted for. Of course, when the IT system automatically produces a log of users and the actions they undertake within the IT system. That log na nag-reflect, kailangan na ma-reconcile na talaga bang may transaksyon na nangyayari to ensure processing integrity. Control totals naman are subtotals of selected field for the entire batch of transaction. For example, quantity ordered could be added for a batch of orders, meaning it is a set of batch totals. There is a control na dapat tingnan, specifically quantity orders like bulks of products to be ordered. It should be ensured adequate controls to this kind of transaction. And the last IT controls that can lessen those risks is the acknowledgement. So acknowledgement is a reply that echoes the data controls total. The use of acknowledgement and matching control totals can reduce the risk of erroneous or invalid EDI data in transactions. When an EDI transaction is transmitted, the receiving computer should transmit an acknowledgement to be compared with original data to make sure it was not garbled or lost during transmission. Illustration below are the risk and controls for e-commerce and EDI revenue processes. So this is kinda a summary of the controls and the risk. So security and confidentiality. So its risk is unauthorized access, hackers or other networks breaks in, repudiation of sales transaction. Its control is authentication like user ID, password, login procedures, access levels and authority tables, firewall encryption, vulnerability assessment, intrusion detection, and penetration testing, computer logs. And the other risk is in the processing integrity, the invalid data entered by customers, incomplete audit trail, errors integrating into back-end systems, and its control naman, input controls, L check, validity check, limit check, and reasonableness check, computer logs, and software testing. And the other risk, the availability, the system failures, virus and worm attacks, denial or service attacks by hackers. And its control naman, business continuity planning and backup data and systems, firewall, encryption, vulnerability assessment, intrusion detection, and penetration testing.
May I ask someone to answer this question? How could it be possible for two companies to conduct EDI if they are not directly connected with each other? Thank you, Christine Sneeson, for answering the question. This is Mary Jo Nobleza reporting. Back to you, Irvin.
Point-of-sale system can enhance customer satisfactions by enabling faster and more accurate checkouts. But how it can reduce some processing integrity risk within revenue and cash collection processes? This will be reported by Mary Joy Nobleza. Mary Joy?
That's right, Irvin. POS can enhance customer satisfaction by enabling faster and more accurate checkouts. The POS system you use is crucial to providing customer satisfaction. It can do a lot more for your business than you may realize. For example, it makes every transaction quicker, something customers generally appreciate. And we are now the 8 objectives of revenue and cash collection processes and controls. POS has already been mentioned by many reporters, so I will only discuss its important toward revenue and cash collection. So, many retail operations use point-of-sale or POS system to capture all relevant sales data at the point of sale, the cash register. You have seen a POS system on your shopping visits to grocery or department stores. As you check out, the barcodes are scanned on the items you purchased, prices were determined by the accessing of inventory and price list data. Sales revenue was recorded and inventory values were updated. All of these processes occur in real time, and the store can provide to its manager or home office daily summaries of sales by cash register or by product. POS systems have many features that assist accountants and managers in the company, include the following. Number 1, touchscreen menus for easy trading and use by employees lead to fewer errors and more accurate sales and inventory data. Unlike traditional point-of-sale system, touchscreen POS systems allow you and your employees to tap on a screen to complete purchases, enter customer data, or locate sales information. Number 2, barcode scanning or products eliminates the need to manually enter products code, quantities, or prices. A point-of-sale barcode scanner can be a productivity booster, pointing out the many benefits of barcodes. Barcodes improve the customer experience by speeding up the checkout processes. Barcodes make it easy to change prices, avoiding the need to retag items manually. Number 3, real-time access to inventory and price data allows for more accurate pricing at checkout, as well as quick and efficient price updates. List prices can be changed online by a manager and reflected instantly at the checkout register. Number 4, credit card authorizations during the sale save time and help prevent credit card fraud. It is true that using credit card dili malangan both the teller and the customer, and it avoids employees' fraud. Number 5, real-time update of cash sales and inventory records allow for immediate analysis of sales trends, inventory needs, and cash in hand. Because of its accurate and reliable automated systems can easily generate updates or analysis of sales or even inventory. Number 6, immediate summaries and analysis can be provided to on-site management or the home office. It can provide real quick with the transaction this day or sold this week. If you have control access toward POS, it's not a matter if you are on-site or home office. You can still check its summaries and other documentation to the files being recorded. Number 7, integration with the company's general ledger system to post sales, cost of goods sold, inventory, and receivables account saves many manual steps. Because the traditional takes time and has a human intervention that could cause risk and errors. POS systems are not usually connected to trading partners outside the company. The system is an eternal system that may have network connections from individual stores or locations to corporate headquarters. Since it usually does not involve outside network connection, it does not pose as many security or confidentiality risks as e-commerce or EDI systems. The POS software system can actually reduce some processing integrity risk within revenue and cash collection processes. The risks lessened are as follows. Number 1, pricing errors for the product sold. Number 2, cash overage or shorted errors. Number 3, errors in inventory changes, less chance of an incorrect product number. Number 4, erroneous or invalid sales voids or deletions. Since a POS system uses extensive computer hardware and software, there are availability risks. Hardware or software failures can make the system unavailable and interrupt or halt business operations. Therefore, it is important for a company to institute controls to lessen the availability risk. Backup systems and backup data procedures should be in place. The organization should also have business continuity and disaster recovery plans in place. There are many examples of POS system in the companies where you have probably shopped. Retail stores such as department stores, grocery stores, and bookstores, as well as restaurants, may all use POS system.
May I ask someone to answer this question? List some advantages of POS system. Thank you, Princess Joy Laorden, for answering the question. This is Mary Joy Nobleza reporting. Back to you, Irvin.
Many businesses and accounting environment are that many deceptions and fraudulent acts related to revenue measurements and recognitions. Irvin Apari will report this matter. Irvin, the fact of the business and accounting environment is that many deceptions and fraudulent acts relate to revenue measurement and recognition. Many managers or owners succumb to the temptation to inflate or overstate revenues so that they can make the company financial performance appear better than it is. Intentional revenue inflation is unethical, and many types of revenue inflation are illegal. There are many examples of companies inflating revenue. One of the examples is the Miniscrib Corporation. In the early days of personal computers, one of the manufacturers of the hard drive was Miniscrib Corporation. The chief executive officer of Miniscrib, Q.T. Willis, was convicted of fraud in 1994 and subsequently served 30 months in prison for falsifying revenue. To inflate revenues, Q.T. Willis came up with a novel idea. He made the employees ship bricks rather than hard drives. In boxes that were sent to distributors, the company also shipped scrap parts in the boxes that were labeled as hard drives. The company inflated revenue by recording completely fictitious, fraudulent sales of the disc bricks and scrap materials. In addition to the CEO being sentenced to jail, the chief executive officers As CPA was disciplined by the Security of Exchange Commission or SEC, the company ultimately failed. If top manager is intent to falsifying financial statement by inflating revenue, it does not matter how good the underlying process and accounting system are. It can still often find ways to misstate revenue despite the effectiveness of the accounting system. Accurate financial reports can only be an output of the accounting system if management desire accurate financial reports. Unethical managers can easily cause fictitious or inflate sales revenue to be recorded, although doing so requires that the assistance of this work who work for the top managers. Since the top managers have so many control over those whom they employ, it is possible for them to convince employees to assist in the deceptions. If Miniscript employees had been more ethical, it would have been more difficult for its leader to conduct the fraud. In addition to the novel approach of Miniscript, there are more mundane ways to inflate revenue. Two popular approaches are the channel stuffing and leaving sales open beyond the end of the fiscal period. When we say channel stuffing, it is intentionally persuading the customer to buy more than needed, thereby stuffing more product into the sales channel. On the other hand, leaving sales open, it refers to moving a period cut-off date forward to include sales that rightly would occur in a future period. This means that the company records sales revenue that should actually be recorded in the following fiscal year. From the accounting system perspective, it is important that the system properly account for revenue in the proper period. This can become complex when the order shipments and payment dates occur near the fiscal year end. The system that records revenue transaction must be designed to include in current periods revenues only those items that were actually shipped beyond year end, and shipments occurring after year end must be recorded in a subsequent fiscal year. The system should be tested to make sure that them handles this sales revenue cut-off correctly. Management has a responsibility to maintain an accounting system that properly recognizes revenue. If management chooses to act prudently, inflating revenues by shifting revenues cut off it easy. This emphasizes that fact that the ethics of the management and control environment are the most important factors in accurate and complete financial statement. Without ethical management of the top of a company, financial report must be suspect. In the real world, in 2008, the Coca-Cola Company agreed to pay a $137.5 million settlement to relate the accusation of the channel stuffing. After an 8 years Security Exchange Commission or the SEC investigation, Coke agreed to the settlement but admitted to wrongdoing. The company had been accused of pursuing bottlers to buy more than soft drinks concentrated than necessary. These overselling techniques added sales, and therefore higher profits to Coke financial reports, and kept the stock price artificially inflate. Those who purchased Coke stock in short period in the late 1999 to early 2000 were entitled to a portion of the settlement. In many cases where revenue is intentionally overstated, accountants or the CFOs have participated in the deception. Accountants throughout an organization should try to ensure that the area in which they work does not overstate revenues. Overstated revenues mislead the general public as they make investment decisions regarding the stock to buy. Therefore, accountants must make sure that the accounting system used to record revenues are accurate. Second, accountants must not allow managers to coerce them into assisting in an overstatement of revenues through the use of accounting tricks or deceptions. In the real world, an example of accountants being involved in revenue misstated in an accounting fraud scam occurs to HealthSouth Corporation. Richard Scrushy, the CEO, and 5 different financial officers were accused in inflating profits by $1.4 billion. The accountants involved claimed that Scrushy held so-called family meetings to help devise and cover up earnings falsifications. In June 2005, to the surprise of federal prosecutors, Screwshy was found not guilty of all accounts against him, even though the 5 other Health South officials have pled guilty and testified that Screwshy ordered the action. Although a jury found him not guilty, Screwshy's job prospect as a CEO is severely damaged. At the minimum, he tolerated and failed to prevent unethical behavior, even though it was not proven beyond reasonable doubt that they participated in that events. Corporate governance implies ethical behavior. What should be done to guarantee that the company assets are properly designed and implemented? To know more, Erwin will discuss corporate governance and the revenue processes. For primary functions of the corporate governance processes includes the management oversight, internal controls and compliance, financial stewardship, and ethical conduct. The systems, processes, and internal control described in this chapter are part of the corporate governance structure. When management designs and implements processes of sales return, and cash collections, it assigns responsibility for executing those functions to various managers and employees. As management assigns and oversees these revenue processes, it is carried out that the corporate governance functions of proper management oversight. Management should also establish appropriate internal controls for revenue processes to accomplish the objectives of safeguarding assets within those processes and ensuring the accuracy and completeness of the data produced by the processes. These internal controls are also part of the corporate governance structure. When management has designed and implemented processes and internal controls, and then continually management them, it is helping to ensure proper stewardship of the company's assets. Corporate governance requires proper financial stewardship. The processes, the internal control, and feedback data from this system help management reports to owners and other stakeholders about proper stewardship to assets within the revenue process. This asset includes inventory, cash, receivables, and operating assets. Good corporate governance requires ethical conduct. It means that it describes some of the ethical issues that management must consider and address within the revenue processes. When top managers act ethically and encourage ethical behavior throughout the organization, stronger corporate governance is the result. There are usually fewer cases of frauds, errors, and ethical problems in our organization when top managers behave ethically and encourage ethical behavior. Perhaps, it would be easier to understand that the way this topic will fit into corporate governance if you think of it from a negative perspective. For example, if management of the particular organization did not establish sound processes, good internal controls, and ethical policies, it would lack corporate governance. In that organization, revenue processes would be poorly executed and weakly controlled. Management would not be exercising proper financial stewardship. Therefore, stakeholders such as investors, creditors, and owners would have little or no trust in the resulting financial statements. The organization would not represent the type of organization in which we would to invest our own money. On the other hand, when an organization has good corporate governance, the stakeholders can correctly have more confidence that proper stewards is occurring. Establishing proper processing, internal controls, and ethical guidelines leads to better corporate governance and therefore good financial stewardship. And that's all my report. Back to you, Erwin. That was the news of truth that bring you the latest news around the world. This is Accounting Information News Express, where the news come first, serving people and no biased. Once again, this is Ervin Lascuña Apari. Thank you and God bless us all.